The rig count data is an important indicator of the natural gas market, as it reflects the level of activity and investment in the exploration and production sector. The number of rigs drilling for natural gas shows how much supply is being added or removed from the market, which affects the balance between demand and supply, and ultimately the price of natural gas. The rig count data also provides information about the production costs and profitability of natural gas wells. The more rigs are operating, the more competitive and efficient the industry is, and the lower the break-even price of natural gas is. Conversely, when rigs are idled or shut down, it means that the production costs are too high or the market conditions are unfavorable, and the break-even price of natural gas is higher. Finally, the rig count data also influences the future price expectations for natural gas, as it signals the market sentiment and confidence of the producers. When rigs are increasing, it means that producers expect higher demand and prices for natural gas in the future, and they are willing to invest more in expanding their output. When rigs are decreasing, it means that producers expect lower demand and prices for natural gas in the future, and they are cutting back on their spending and production. Therefore, by tracking the rig count data, we can get a better understanding of how the natural gas market is influenced by the supply and demand balance, the production costs, and the future price expectations for natural gas. One of the key indicators of the natural gas market is the rig count data, which shows how many drilling rigs are operating in the United States. The rig count data reflects the level of exploration and production activity, as well as the supply and demand balance of natural gas. In recent weeks, the rig count data has shown a divergence between oil and natural gas rigs, with oil rigs declining and natural gas rigs increasing. According to the latest figures from Baker Hughes Co. BKR, natural gas rig count rose 6 units to 156 for the week ended Friday, Jan. 20, while the oil rig count dropped 23 units to 615. This is the lowest level of oil rigs since June 2020 and the highest level of natural gas rigs since April 2020. What factors are driving this divergence? One possible explanation is the weather. The winter season typically boosts the demand for natural gas for heating purposes, especially in regions that experience cold snaps and snowstorms. This year, the U.S. has faced several extreme weather events, such as the polar vortex in February that caused widespread power outages and gas shortages in Texas and other states. These events have increased the volatility and uncertainty of the natural gas market and may have encouraged producers to ramp up their drilling activity to meet the demand and take advantage of higher prices. Another possible explanation is the price difference between oil and natural gas. The price of natural gas has surged in recent months, reaching its highest level in more than 2 years in May. The price of natural gas futures for June delivery increased 2.1 cents, from $2.170 per million British thermal units (MBTU) last Wednesday to $2.191 per million British thermal units yesterday. The price of natural gas is influenced by several factors, such as weather, storage levels, exports, and production. On the other hand, the price of oil has been relatively stable, hovering around $60 to $70 per barrel since March. The price of oil is influenced by global factors, such as OPEC Plus production cuts, vaccine rollouts, and geopolitical tensions. The widening gap between oil and natural gas prices may have made natural gas more attractive for producers who can switch between the two resources. A third possible explanation is the pipeline capacity. The U.S. has seen a significant increase in its natural gas pipeline infrastructure in recent years, which has improved the transportation and delivery of natural gas from producing regions to consuming regions. According to the U.S. Energy Information Administration (EIA) about 17 billion cubic feet per day (BCF/d) of new natural gas pipeline capacity entered service in 2020, and another 8 billion cubic feet per day is expected to enter service in 2021. These pipelines have enabled producers to access new markets and customers, both domestically and internationally. For example, the Permian Highway Pipeline, PHP, which began operations in January 2021, transports natural gas from the Permian Basin in West Texas to the Gulf Coast, where it can be exported as liquefied natural gas, LNG, or used for industrial purposes. A fourth possible explanation is the offshore exploration. The U.S. has also seen a renewed interest in exploring and developing wells in deeper water, especially in the Gulf of Mexico. According to the Bureau of Ocean Energy Management, BOEM, almost 40% of bids in its latest lease sale in March were for projects deeper than 1,600 meters. These projects are expected to yield more natural gas than oil, as deeper water tends to have higher gas-to-oil ratios. Offshore exploration is a long-term and capital-intensive endeavor, but it may offer higher returns and lower risks than onshore exploration. In conclusion, the recent trends in the rig count data show a divergence between oil and natural gas rigs, with oil rigs declining and natural gas rigs increasing. This divergence may be driven by several factors, such as weather, prices, pipeline capacity, and offshore exploration. These factors may have different impacts on the supply and demand balance of natural gas in the short term and long term, and may affect its price movements and market outlook.